he wants us to get, we say at least 5 referrals?
Yeah, I mean, it's not so much the
Number.
number, it's just that based on the growth of our referral business, you'll see the growth of your dollar business as well, right? So, but from now on, it's not gonna be where it's like, we go out and see a client and we don't ask, we're gonna ask for referrals. We're gonna have everything documented, we're gonna be submitting these, we talked about all this, and I'll go over it with you later. But all this stuff will be documented, and all this stuff will allow us to see where our issues are, if we have any, where we can work on. But this is something we'll turn in. I know you submitted a couple, even if it's 0, nothing, submit them. But most importantly, what we talked about is even if it's DCC, if it's a DCC client, we're gonna ask for referrals, especially when we go back out and deliver the policy. If it's an in-house client, if you didn't make a sale but you got 5 referrals, I'll give you 2 high fives instead of just 1, because that's more, there's more benefit to that than any sale. But if you're able to go out there and help a client and put them in a better position, and get referrals out of that, then that's gonna be your ultimate, that's gonna be the ultimate compensation, okay? So that will allow you, so now referrals will definitely be a part of it, and I mean, there's no reason for it not to happen, you know, unless you're not seeing anybody then, at that point then. And then I was talking about the 3 different types of clients. The first one is the in-house, the 4 type of in-house clients that we have are the term clients that either, I'm sorry, the clients that no longer have insurance with us, we're gonna go put them back on the books. The clients that do have term policy with us, that is either ending or is not meeting their life expectancy or doesn't have life benefits or living benefits, okay? The third client is the annuity client or the IUL client. And those are they bunch them up together because really none of us, except Richard, and even then we're not there yet. I mean, I'm not running those clients yet, just because I want to, when we get those together, and although you still have them, we put those together and we get to go out there and you know, we'll focus on that. The 4th client, in-house client, is the one we'll be talking about today. And that's the client that either has a underfunded or underperforming universal life policy. And that can happen for many, many reasons, okay? So one of the reasons it happens, and the main reason it happens, is because initially the first agent that went out there and saw them ran him at what's called minimum. Meaning that their policy that they were paying was just minimum amount to keep the policy going for a certain amount of years. If that wasn't increased to what's called target, then the policy was not going to run or perform correctly. So a lot of them are set up that way. And the reason that happened is because agents wanted to make a sale. They wanted to go out there and present the least expensive product that the client could have to put them in a situation where they made a sale and the client believed, they created an illusion that the client had permanent insurance. Because universal life is a type of permanent policy, right? But it's not, especially back then it wasn't guaranteed. So that's the first underperforming or underfunded, and typically it's for that reason. Sometimes what happens when underfunded is guy has it on target set up correctly, and then they lose their job and they have to they want to keep the insurance, so then they go what's called as I'm paying on minimum just to keep the policy going. But then they never go back to target, and then the policy. The underperforming part is the part where the policy, the interest rates aren't working at the level where the non-guarantee was. So a lot of these agents went out there and they showed a client to age 90 non-guarantee at 5.65%. Well, guess what? Performance isn't at 5.65, it's at 3%. So what does that mean? That difference has to come out of your pocket, right? So then they are under the impression, because nobody's seen them, that they have permanent insurance, but because it's underfunded, the cash value count isn't going to sustain, then the policy is just basically a glorified term policy, okay? The last, and the very rare, which is actually right here, is a combination of several things. Underperforming, underfunded, and then guess what they did? Agent went out there a long time ago and said, listen, when you have this policy, it builds cash value. And you can use this cash value to supplement your finances, okay? Well, that's sad because this individual under the impression that this policy is going to allow them to have or allow them to have a savings, so to speak, so they can use it, and they're not aware that this has to pay back, they have to pay this back at a certain interest rate, and if it's not paid back, then the cash value doesn't grow the way it's supposed to, and then boom, the whole policy implodes again. Right, so this policy is in that position. This is gonna be a review which Jerry and Jerome are going on Friday. The guy's spending $600 a month on a $100,000 policy, okay? Now, the way we'll do this appointment is we're gonna do the review, okay? These are all in-house clients. We do the review first, right? Okay, so the review is part one. Any changes that need to be made, we're writing them down. We do all that, and then we get into the what they have as far as the actual policy itself. Then we ask them if they understand what they have. And most times they don't understand what they have, right? So then we show them how a universal life policy works. And that's a big one, and I'm gonna show you how that works on the board. The last thing is we do is we offer them a solution to that, right? And that's gonna require facts. It's gonna require documents showing them where the position's at right now and where the position will be if we're able to help them. But that's all based on documents, okay, and facts. And we have to, in order for us to get all that, we have to do what's called case study before every appointment. And right now, all case study is done with me. There's gonna be a point where you're not gonna need me for it because you're gonna have a really good grasp of it. But for now, all case study is done with me. We basically spend about 20-30 minutes on each appointment before you go on it. Jerry likes to record it, great. Richard, we run all the numbers prior, run all the options, we do all that. But regardless, we go over the whole presentation prior to going out there. So this client right now will start, and here's the last part to this. Most of the time, 80% of the time, we have the house file, the original file that the client wrote with us, original application the client wrote with us, and it has an illustration there and it shows everything. That's ideal. Sometimes we don't. In this position, we don't. But for the most part, what we do have is we have what's called a enforced illustration showing what they do, what they have, what they pay, who their bank accounts with, their beneficiaries, and last, most importantly, how long their policy is going to last. And that's the most important thing. We just don't have social, we don't have driver license, but it's okay because we have most everything, right? So this happens to be a client that's underfunded, underperforming. He borrowed money from his account, and we don't have his original file. Okay, so the appointment starts like this. So build some rapport, and hi Joe, when was the last time somebody came out and met with you? Did a review with you?
2 years ago.
2 years ago? Wow, that's actually not too long ago. That's pretty recent. Who was? Do you remember who the gentleman was, or the agent?
John.
John? Oh, okay. John came out and did the review with you. And what were you able to understand from the review? What were you able to obtain?
And I'm supposed to have it for life, permanently.
Oh, okay. So 2 years ago you came and you told you you had permanent insurance, right? Alright. You making changes or anything?
No.
Okay, so no changes were made. Alright, so you have on here, your date of birth is March 10th, 1942, correct? Okay, and you have a $100,000 policy, and right now you're paying $600 a month, right? Okay, and so your beneficiaries are primary 100% Justine, your wife, and contingent I have Josephine at 34%, I have Martha at 33%, and Jose at 33%. Okay, that's staying the same?
Yes.
Daughter, son?
Yes.
Okay. Alright. And your payment is being drafted on a monthly basis out of your Bank of America account?
Right.
Ending 1536?
Yes.
Okay, good. Alright. Alright, so you took out this policy in March of 2005, so it's been 12 years since you've had this policy, okay? So $100,000, and you're under the impression that you have permanent insurance, okay? Right. Okay, so what I wanted to go over today is what you really have, okay? So when this policy was written up for you, it was called what's called a just universal life plan, meaning that it is a permanent type of coverage as long as it's funded and it performs correctly. Okay, so I'm going to show you how that works. So the way it works is that you have what's called a universal life, and you have what's called a cash value account. Okay? That cash value account is a very, very extremely important part of this policy. This policy, the cost of insurance will never stop going up. Okay? Your premium, however, is supposed to stay level. So when you got this insurance 15 years ago, you were age 65, right? And your cost of insurance was $250 a month. At that time, you were paying $362 a month, $350 a month to make it simple, right? $350 a month is your cost of insurance, or your premium. That's your premium, okay? At 65, you're paying $250 is the cost of insurance. $350 is what you're paying in the premium. There's a $100 difference, right? Where does that go?
Cash value.
It goes into your cash value account. Okay? At age 70, you're paying $300 a month for your cost of insurance. Your premium is $350, and you still have a difference of $50 a month. Where's that going? Cash value account, right? Now, the interest rates in the policy when they first gave this to you was at 5.65% non-guaranteed, meaning that the policy performed correctly and it was funded correctly, and you'd be receiving 5.65 on this money. Well, right now, and I'll show you the illustration, it's performing at 3%. Okay? At age 80, where you're at now, the cost of insurance is now $500 a month. I'm sorry, it's $500 a month. Well, if you're paying $350 a month and your cash value is depleted, where does the difference come out of? Out of your pocket, right? So $150 a month comes out of your pocket. Well, you recently borrowed $16,000 out of your cash value account, right? And your premium went from $362 a month, which is on paper, to $553 a month, to now $600 a month. Do you think that your $600 a month premium is going to stay at $600 a month? When you're paying $500 for the cost of insurance, do you know where the other $100 is going to? It's going to paying back the cash value with interest. But you're a little too late for that, because now this isn't going to grow the way it's supposed to. It's not going to perform the way it's supposed to. So this $600 a month, just like it was $380, then it was $430, then it was $500, now it's $600. This is going to continue to go up. You can see that, right? It's going to go up so much to the point where this may not make sense to you. Now, right now you're 75 years old, right? So you're hoping, you're almost at life expectancy. You're hoping that this and this together will allow you to, this will outlive you. That's what you're hoping for, right? That's where you're at right now. Now, unfortunately, because you're in this situation, the cost of insurance and the amount of premium that you're going to be paying is unpredictable. We don't know what it's gonna be next year, we don't know what's gonna be the year after that, but this is definitely gonna go up. And it's gonna go up dramatically, okay? So, is that the impression you were under? Is that what you thought you had?
Yes.
You knew you had this right
No,
now?
no, I thought I had
Okay.
permanent.
So the reason you've already experienced the cost of insurance going up. You've already increased your premium. As a matter of fact, you just authorized Bank of America on March 17, 2017 to start taking out $647 a month. You pass that around? So he went from 380 to 430 to 500 to 600 to 647. That's not going to stop. Okay? And that's because he currently only has 5,000 in his cash value account, but that is being taken out in big chunks. His cash value accumulation should be at 24,199. He borrowed 16,000. Plus, it wasn't funded correctly, so he's only got 5,900 left in there. He's going to be paying 4.76% on the loan amount, and he's only making 3% on his cash value accumulation. Do you see the negative there? That's the same. It's just negative all the way around, right? So, Mr. Cobbs, when I come out here and I go over these, everything with you, I make sure that you're fully aware of how your policy currently works. Do you have any questions on how your policy works right now?
How do I know what the cost of insurance is? Does it say anywhere?
Right. Well, the cost of insurance is, and I'll show you. I'll show you. That's a good question. It actually does say it on here. I saw it earlier. But I may need to print it out. So the cost of the insurance $278.
Currently, right now, right?
Okay, so how much cost of insurance is. Why are you paying $650?
It's underfunded.
What's underfunded? And you borrow money.
Borrow money.
Yeah. So you're paying
Plus, he's paying the interest on top of that.
You're paying $400 a difference that's going to that loan amount, right? So basically, this is no different than a mortgage that was given to you 10 years ago at 10% interest rate. It's no different. Okay? It's no different than an ARM that was given to you 5 or 7 years ago. If you were in a position that you had an adjustable rate mortgage that started at 1% and now is at 7, it's going to continue to go up, what would you be doing right now? You'd be refinancing. 100% you'd be taking advantage of the guarantees in the mortgage industry nowadays, right? It's no different than that, Joe. Furthermore, in the actual current statement, which you actually received in the mail on the 17th, it shows that your policy, if the premiums aren't made in the increasing amount, your policy will lapse on October 17, 2017. Pass it around. Okay, Joe, I hate to be the bearer of bad news, and often I am. Now, currently you're in a position where the policy is not going to last much longer, right? And you've been paying for 15 years now, and obviously it was extremely important to you, and that's why you've been doing it. So what we do is when we come out here, we try to find a solution for our clients, right? A lot of times the solution is going to cost more money. A lot of times the solution requires us to reduce the amount of coverage that the individual has, so it prolongs the amount of coverage, so it prolongs the insurance. A lot of times we can't do anything. The individual's health just doesn't allow us to do anything, and unfortunately, this is the best thing for you. So Joe, a couple things. How's your health since we last did this? Has it changed? Okay. No high blood pressure, no cholesterol, no diabetes, no major surgeries, no heart problems at all, no cancer. Okay, excellent. So the options that I have for you today, and like I said, these are basically options on what we can start as far as being able to replace what you currently have and put you in a better position. Because at the end of the day, I don't know if this is actually going to be something that we can do for you. This is going to be 100% based on your willingness to do this, which I'm sure you are. You want to you want to be in a better position, and B, also the fact that the insurance company will make you an offer if you're healthy enough to be able to put in that position. Okay. All we're doing today is showing you the options, starting the underwriting process, and in about two to 4 weeks, we're going to find out if we can move forward with you or not. So the options are this, okay? If you're in a what's called a standard healthy underwriting, then we're going to guarantee you, we're going to put you in a position where we're going to guarantee you to either age 120 or 100 with two companies. It's going to be Lincoln National or United Omaha. Lincoln National is going to give you a guarantee to age 120. Now remember, this isn't for cash accumulation purposes. It's strictly for one thing. It's strictly for the life insurance. It's going to cost you $442 a month. Okay? Why is it less expensive? Well, it's because you're not paying back the loan and interest, right? So the next option is going to be Mutual of Omaha, and they're going to be at about $547 a month. Okay? And the reason we're going to do both applications is because we're hoping that one of them gives you a standard rating. So we're going to try to, as brokers, we're going to try to put you in the best position. We're going to do what's called dual apping. We're going to put you two companies to see who makes you the best offer. It might be as low as $442, it might be as high as $547. One thing we're definitely going to know, if you get approved, Joe, the premium's not going to go up, and the policy is going to outlive you. The last option we have is through a company called Protective. And if you do have health issues and you are older, they may do what's called table rating. So I prep myself and I put you at what's called table rated 2, meaning that this is going to be one of the worst case scenarios, okay? And that's for $100,000 going to lock you into age 95 for $585 a month. You're still going to be $100 less almost than you're at now, okay? Now this is going to require for me to do 3 applications. Nurse is going to come out, do a physical, but we're not going to be able to do anything until the insurance company either makes you an offer or lets you know that unfortunately you don't qualify. Does this process sound fair enough to you? Okay, great. It'll take me a few minutes here. I'm going to fill out an application. I'm going to go over everything with you, and then we'll set up the nurse. And one thing I pride myself on is keeping my clients informed on their current underwriting process. Okay. Another and the last thing, one of the great things about this is that you have a surrender value in your current policy. So you have $5,900 left in your current surrender account. Also, the $16,000 loan that you borrowed against. What would happen is this new policy would replace your old policy. You would no longer be on the hook for the $16,000, and with some fees here and there for the interest and so on, you'll be getting back some money as well, $5,000 or so. Okay, but again, this is not something we're going to be able to determine today until we actually find out if you qualify for the new program. So he has current surrender.
So if he asks what cash value I have, this is the answer you've got for him.
Yes.
Yeah.
So the current cash value that you have, because you're supposed to have 24,000. You borrowed 16. There's a 2,000 surrender charge that covers fees and so on and so forth, meaning that you'll have about $6,000 left. Okay. So this, by the way, in your current position is going to be eaten away in months. But if we're able to move you over to a new program where that's going to outlive you, then not only do you put yourself in a position where you're paying a little bit less, you're locked in, your premiums are not questionable and how much they're going to go up in the next year and the year after that. It's not an undefined amount. You know how much it's going to be, level, guaranteed. And lastly, you're going to be off the hook for that existing loan, which is huge, and you're also going to have an ability to be able to get some of your cash value back. Okay. All right. So, any questions on this?
I do. How does someone get off the hook off a loan?
Because the loan is based on their own money.
It's based off
Yeah.
their cash value, which
Oh,
is
I
why
see.
he's down to like about $5,000.
I see.
that would be, to me, one of the, if I'm the client, I'm supposed to have cash value, where is it, what
Right.
am I getting back out of
Right.
this?
Right, and so here's the thing, one thing you definitely wanna let them know is this, Mr. Cobbs, I'm not an accountant, okay? So, based on the loan and however much it accumulated over time and how much the difference between the cost of insurance, you may have to pay taxes on this money. I don't, that's not my, that's not my area of expertise, okay? I know if everything goes the way it's supposed to, you'll be off the hook on the 16th, plus you will receive some cash back, but as far as the taxes, that's something you'll have to deal with your accountant, okay? Right? Does that make sense?
Well,
Tell me your thoughts.
because they're borrowing the money, they shouldn't have to pay taxes on it. Yeah.
What?
Now it all depends on how that account is being funded.
Right, but if it
You know,
surrenders,
after tax.
if
Yeah.
it surrenders, the taxes may become, because now, if the cost of insurance is one thing, but if the accumulated, now this would be a big issue if the guy was like earning 10% interest rate and
Right.
accumulating,
Right.
it's probably not gonna be an issue, but I always say that to make sure that I'm clear, right? Especially as a senior citizen, I'm not the accountant, probably not, you're not earning much more than what the cost of insurance, but the fact that that may be an issue, you have to talk to your accountant about that. Now, like we said, if the guy was making 10% interest, if he's making 10% interest over 10 years, his cash value is gonna be higher than the amount he's put in there, right? But we can easily do some math here.
Yeah, and now the one thing to add to it is, you'll know definitely if the amount of money that you dumped into it, if you've taken out more than that, then that's where that issue may come
Right.
into play.
Right.
But if what you dumped in and you have not pulled out that amount, then definitely you're not gonna have to pay taxes on
Yeah.
it.
But
Because-
you wanna get yourself off the hook and do what he says.
Right.
Simply say, you need to consult an accountant to be
Well,
positive.
absolutely. I mean,
Yeah.
you wanna make sure, absolutely.
Yeah.
Cause see, the one thing that I don't know is because I haven't looked at the policy, I don't know
Right.
how the policy is being funded, I don't know where the fees are getting taken out.
Right.
So I would definitely not tell them,
Not
I
the-
wouldn't
yeah.
be the one to say, hey, look, this is your situation where
Yeah.
it stands. And another thing that they have, that all the insurance has, is they can actually call the insurance company
Yeah.
and get a standing on what the loan amount is,
Right.
and if there's gonna be some taxes.
Right.
And then they'll send them statements too
Yeah.
at the end of the year, because they do get annual statements on this
Right,
every
this is
single
every
year.
year, this is the annual
Yeah,
statement right
yeah.
here. But, I mean, there's, everything that we talked about is based on facts, everything's on here, I mean, even the last part where it says lapse on 10/17/2017. There's no other way to put that, I mean, this
Yeah.
is.
That's huge.
Right. Okay, so we can try to find a solution for it, that's the best we can do. We don't even know if that's gonna be a solution, but we're gonna try. It's not gonna cost you anything, let's try, right?
So like the Mutual of Omaha policy that you're suggesting that will cover him till
Age 95.
95.
That's the worst, that's probably gonna be his worst case scenario.
Worst case scenario.
Yes.
And
I'm sorry, that's protective, that's the worst case scenario.
that's protective, okay?
Yes.
Cause I thought the Mutual of Omaha, you said
To age 100.
age 100.
Yes, so Lincoln does to age 121. Here's the cool thing about Lincoln, okay? They all do to age 121, but you can set them up.
The guarantee.
Yeah, you can set up the guarantee to start. But the cool thing about Lincoln, and if you don't know this, now you know, is they do what's called table shaving. Are you familiar with table shaving?
No, I remember that terminology now.
Okay, table shaving, if they're table 2 or higher, table 1, table 2, they will shave it and give you a standard. They do 2 table shavings. So if you're a table 4, you're a table 2 with them. They will table shave for it. So, and they do it for senior citizens, okay? So Lincoln National is a great company. If you have a client that maybe is on the cusp of having a table rating, they will do table shaving. Please look it up, it's extremely important
And-
to know that term.
Obviously, there's multiple different policies. What's that policy referred to as far as like the name of the?
The name of this program is called Life Guarantee UL 2013, okay?
Is that
To
through
age
Lincoln?
120, yes, Lincoln
Okay.
National,
UL.
okay?
Lincoln's that's a pretty good company.
Yeah. So remember, if you do an app for Lincoln and you're not contracted, all you do is write pending, submit it, and by the time you get contracted, this is a complex case anyways. It's not gonna, especially if you have a surrender's not as bad, because we're not gonna have a 1035 in this, okay?
Right.
We don't need it. Sometimes you do need a 1035, because let's say this guy, his payment was gonna go from 650 to 800, and he has 6,000 as cash value. Well, guess what that does? That cash value is 1035, will go into a new policy, and that will reduce his monthly premium payments, because that will supplement. Now, that's needed a lot of times. In this position, it's not, and that's just for one simple reason. that's because he borrowed a ton of money off of it, and now he's paying it back. So let's get rid of that. Why would you wanna do that if you don't have to, right?
Right.
There's not, I mean, it's not gonna affect your credit, by the way, and that's a very simple and silly question, but some people don't know. It will not affect your credit. None of this affects your credit. If you don't make payments on your
Cash
life
value.
insurance policy, if you don't, it's not gonna affect your credit. It has nothing to do with your credit. Okay, it's called what's called a bilateral agreement. We give you insurance if you give us money. If you don't give us money, we don't give you insurance. Sorry, it's unilateral. And so, any questions on this? Any questions on how UL works? I know it's a little complex, but,
So that's an IUL or that's a UL?
okay, no IUL is only for supplemental retirement. It's a UL, so we'll, whenever IUL comes up, I'll definitely go over that. IUL, by the way, is for that supplemental retirement, right? That's the real reason. Now, a lot of people, back then, they used the two for insurance. Now, that may happen, and in those cases, I'll let you know, but UL for insurance purposes only, IUL for supplemental retirement. This guy has it for insurance purposes. And so we don't have to go into anything about supplemental retirement or anything.
So for universal lives, you're not supposed to take out loans, right? Because they're supposed to
Right.
maintain the period that you have it.
Right.
But for universals, you can't, or IULs, because those are supposed to be for retirement.
Right, so that's the thing, an IUL, if you fund it correctly, and you should, because that's basically the whole purpose of it, you overfund it. And that 7702 IRS code that allows you to overfund the cash value account of a universal life policy for supplemental, you can call retirement purposes, supplemental financial purposes. You can actually set what's called income streams. So as long as it's done correctly, let's say a guy's been doing it for 30 years, putting $300 a month, then an illustration will show how much he's going to be able to extract from the loans on a yearly basis. Those are all loans. Now that's supplemental retirement. It's tax-free because those are loans, right? The moment it modified endowment contract, the moment that occurs on an IUL, basically you take out the lump sum or you do, that's where everything we talked about, the taxes become an issue.
Yeah.
Because now your cash value is way higher than the amount of money you put into it. And that's because that performance of that policy is made to perform at a higher level with the higher interest rates, index and all that. So if your policy is performing at a higher level and your cash value is grown to a higher amount that you've put in there, the difference of what you take out is going to be taxed, because at that point it becomes a modified endowment contract. That's the reason to do loans, and that's the reason you do it, and that's the reason you never go out there. And some people do this. They say, "Oh, this is going to be the amount of cash value you have accessible." If you say that, then you have to also tell them that there will be tax consequences in this. At that point, it's no longer a tax-free situation. Okay, but that's an IUL, and that's for another day, and that's even a little bit more complex. But a UL is the new ULs have guarantees, and that's where we don't have to worry about the cash value accumulation. Listen, Joe, if you're negative on your cash value because it doesn't perform right, it doesn't matter. You're guaranteed. Guess who takes the hit? Insurance company does. And as much as they don't want to pay you, they're forced to by the government. That's who governs them. And Department of Insurance, as much as they don't want to pay you out, and as much as they want you to pay the difference, once you guarantee it, it's a done deal. It's a contract, and you don't have to worry about that. In your current situation, you don't have that. You don't have a guarantee. You were just hoping that everything was done correctly, and if it was, then it may have outlasted you. Unfortunately, that's not the case right now. But, I mean, every case when an underfunded or underperforming is typically the same. It's just a different individual. Different numbers, but as far as the theme of it, it's all the same. Besides, this one has one extra element that typically is not there, and that's the loan amount, the fact that he took a loan out. Okay? So this is a little bit more unique, but it's a little more complex, which is good, because next time we talk about just the UL underperforming or underfunded, then it's a little bit easier to understand. So any questions on this stuff?
The UL, I don't know nothing. This is all new to me. UL and IULs and all that stuff is new.
Okay.
you gotta
So the
kinda-
universal life policy, so we just did it right there, didn't we?
Yeah.
Okay.
You gotta click. I'm just saying.
Okay.
It's all new to me.
You know what, Manny, is, I know Forrester, you know how the protective life is nice because that thing will last you. Forrester used to have a product like that and it was guaranteed, it was really nice. Cause I know a lot of lawyers and stuff, when they're looking for policies and they want the guarantees, a lot of insurance policies don't have those guarantees on them. And, it's nice when you have those ULs that have those guarantees on there that you can actually see it. So you know the policy, as long as those premiums are paid, the policy's gonna be enforced.
Yes, yes.
That's a big deal.
That is, real quick, I know we're gonna call this here shortly, but I'll do a quick demonstration on a UL again, the way it's supposed to be working, okay? Now, remember, this is the old way, we don't have to worry about this much anymore, because everything's guaranteed now, right? But in order for you to show your client what happened to his policy and why it's not functioning, you have to know this. So universal life, in order for it to function correctly, that's all I'm gonna show you right now, and then we'll show you what happens in each individual case. But in order for universal life to function correctly, certain things have to happen. Cash value, part of it, has to be funded, and performance has to be done. It all has to come together. How do you spell performance?
F-O-R.
I'm not worried about it, all
You got it. that's
Performance.
good.
So the performance is based on an interest rate to an account that's assigned to you. The funding is how much money is going into, right? If a guy is paying minimum, then it is not funded correctly. If the guy's paying target, then it's being funded correctly. And as long as the interest rates are working right, then this is going to be good. If the interest rates are not performing the way it's supposed to and it's at target, guess what? It's still no good. Does that make sense?
Mhm.
Because it has to be the combination of both of these in order for this policy to work good. It has to be at target, which means the premium has to be paid at a certain amount forever, and then the performance has to be at whatever it is. So if let's say it's at 5.65 non-guaranteed, it has to be at 5.65 or higher in order for it to work right? If any of these two elements are not working together, then this policy is not performing correctly. But it has to be a target. Now, if it's at minimum and the performance is, at 5.65, it's still not going to work because all they're putting in is a small amount of the cost of insurance, which nothing is really ever going in here. So it doesn't matter if it's 100%. If nothing going in there, it's not going to grow. Does that make sense?
Yeah, it makes sense.
Tell me where.
My mind's just working in terms of, this is in order to get the cash value out of it at the anticipated time of when it matures.
It's not to take anything out. It's just so that way, when it's time for this to start kicking back, it's funded correctly. Because remember,
In terms to cover the cost of rising insurance.
yes, sir. So the cost of insurance, remember, it starts low, and then it continues to go up, right? So at age 50, it's here. At age 60, it's here. At age 70, it's here, right? It's $200, $400, $800. Your level premium is $300 a month. So at first, or $400 a month. At first, you're putting $200 into your cash value for 10 years. After that, you're even. So now you have 10 years worth of you have $24,000 plus interest in your cash value, right? Does that make sense?
Okay.
Plus interest. So if this grows correctly, now maybe you have $35K, and then you get to this point now, cost of insurance is $500, it's a negative $100 a month, you're still paying $400, the difference is now coming out of here. Now the interest rate's still working, so the cash value is still growing, but the difference is now coming out of there. Age 80, this goes up tremendously to $800 a month, and you're still paying $400, well there's a $400 discrepancy. Now that's going to start coming out of here, and now at this point, this is affecting the cash value in a negative way because even the interest rate is probably not keeping up with that $4,800 that's coming out of the yearly basis, right?
Right.
Because towards here, in these years right here, that's where this is affected tremendously because the cost of insurance rises so much. These years when you're younger, that's when you're if you're funding it correctly, and the interest rates are working, that's when you're working on it. The later years, that's when the negative. Anything like borrowing from it, not performing correctly or not funded correctly will affect that.
So you have a universal life, which you fund it till 100 years?
Well, you can
Or
fund. There's
could
way.
go to 121, obviously,
well,
right?
you can fund it. You can actually there are setups where you can fund it till age 90, but you're overfunding it,
Right, and it
Right.
should be paid up at that
and it's
time.
called paid up.
Yeah,
but that's complex, and we don't have any
Yeah.
situations like that. We don't
Right,
have to worry about that.
but
Well,
my
you may have
question
to.
is let's say somebody they're hooked on universal life and they want a universal life policy,
Right?
okay?
So
I mean, because they're thinking, well, I got cash value in it,
okay,
okay? So they're hung up on that point.
right?
And you write them to age 90, but they're living to, I mean, they're in excellent health at age 90,
Right.
okay? Is this like a term policy where now it's done?
Okay, so
It just
currently,
evaporates?
in the new situation?
Yeah,
Yes, okay, that's a good question. Because the guarantee now, remember the guarantees on a universal life, a GUL nowadays is done, not so much focused on the cash value accumulation. It's only focused on the guarantee. So yes, it can be a glorified term.
okay,
So if it's to age 90, to age 95, these are all factual. You can do it this way. To age 100, to age 105, to age 110, to age 121, up to 121.
Right.
So this is now the reason this happened. The reason they're doing this now is because old ULs weren't working. Now, individuals are in the same situation where they thought they had permanent insurance, and there's so many factors to that that the high percentage of them did not perform, were not funded, or even the fact that the loans were taken out. All that stuff affected the way the policy works, right? So now you have a GUL that's guaranteed. You're not worried about the cash value accumulation. You may not even have any cash value accumulation.
right,
Okay? You may be negative on the cash value. You don't know that. You actually may have some cash value, and if you do, then you could take it out. And at that point, then the whole guarantee, and it'll tell you the GUL is eliminated from it now because you've affected it.
you've touched it.
Right.
Right.
So now the way it's explained and the way it's shown is a lot, I guess, user friendly. I guess you want to say, because
Yeah.
now it's just based on the guarantees.
On the fact that it's going to help pay for itself and cover that rising cost to whatever age you think.
Right.
Now, and I'm sorry, guys, I'm
No, it's
weirdo
okay.
at times. The reason I bring this up is because recently a genetic show that I was watching has proven that lots of times if your grandfather lived to 110, you have a good chance of living to 110 regardless of your health situation sometimes.
Okay.
Okay? And so that kind of thought runs up.
Mhm.
When did your dad die? What can we anticipate out of your life expectancy? Because maybe 90 is not good enough.
Right.
All the men down your family tree have lived to 101.
Well, I'm gonna answer your question right now. That's good that you're actually looking way deeper into your clients. So I'll answer that right now. What my thoughts are on it.
Yeah, see, that to me, that's what's exciting about the GUL is because the emphasis, and see, there's no mis ands or buts about it. The emphasis is on the insurance. And see, when you look through the term policy, and that was one of the biggest problems with that, after that term end, there was still needs for insurance.
Right.
But a lot of times, people's health may have changed, and that's why, back in the days when we were writing those term policies,
And that the cost of insurance was just
they were
out of
very
touch.
angry. They were very
Yeah.
angry because
Right.
now their term end, and they still needed insurance, and now they had to get insurance, and then they say, I didn't know this policy was gonna do this.
Right.
Well, now they have this, which is perfect, because it guarantees it's gonna last you. You put in a number at age 90 or age 121.
Right.
The emphasis is on the insurance, and as long as you make the premiums, the insurance will last.
Right.
And see, that's sweet.
Right. So that's an excellent point. Let me go over something that you said. If you're doing that with each client,
Right.
then you're going above and beyond,
right.
and that's great. That's fantastic. That's where your client. I mean, if your client sees that, that's amazing, right? However, as a group, what do we focus on? What?
Mortgage
Well,
and
besides that, male life expectancy
right.
is what?
76,
Female.
81.
If we give a person guaranteed to 90, what are we doing for them?
Going above their
Yeah, we're
traditional expectancy.
right. We're going putting the male over 14 years above what they're expected to live, and a female 90. Is that better than a guy that came in and wrote a guy a universal life at minimum, and then it lapses at age 72 or age? Of course. Now, what you're doing obviously is deeper thinking, and that's great. You go over your client, you tell them that. Listen, as a group, what we do is we don't do anything under 90. We make sure that if we're going to tell our client they have a permanent type of insurance, not only do we let them know how long it's going to last, but we also don't do anything less than 90, okay? And so that puts you at 14 years over the average expectancy and 9 years over the average expectancy for female. However, I do what's called, and then now you got what's called a mortality analysis. And all that stuff, now you have to actually introduce that to the insurance company. If you do something like that, you actually have to submit it with the application. If you talk about, you know, your father's genetics and this, it's called mortality analysis, and there's a form for it. And now you have to submit that to the insurance company. So, you know, yes, it's great, but it does require that you know, a little more. There's going to be more information that you have to submit, more forms you have to sign. And that's
Right.
great. It's fine. I mean, I'm sure that's not
Yeah.
the concern. But by doing this, we're just making sure that our client, as an average, is covered at minimum. That doesn't mean we won't do to 121 or do. But right now, if a guy's policy is going to end next year, he's age 75.
Yeah.
Or we go out there and guarantee him to 95, because that's the minimum I ran it for him. That's
Right.
20 more years at what he's paying now or less. What am I doing? Of course I'm doing it better,
Yeah,
even if it was just
absolutely.
10 years. I mean,
Yeah.
but he's going to know that.
Yeah.
A, because he's 65 and older, it doesn't matter the age, but he's definitely going to know that. And B, he's going to be in a better position. But if you do what you're doing, and then in anything, not just that, then your client will know that you're doing something even deeper for them. You're taking an interest in them, and obviously that's reflected. But what we do is we do it as an average, based on an average, and we do it a lot higher. Does it all make sense?
Yeah, and also to add to it, Manny, is if you have a client that, let's say, if you ran it to age 121, it's basically out of their price range, their budget. You reduce it down to age 90 and it's more
Yes.
affordable, and now you still realize that the life expectancy is average age 76, so you still done them a service because
Oh, yeah.
they still have insurance. But see, the thing that a lot of people may not be aware of is after age 80, they can't get the insurance anyway. You see what I'm saying? Most companies, age 80, age 85 is the issue rate, so you can't get any more insurance.
And
after
that's-
that. And you've exceeded that with 90.
And see,
that?
that's my thought pattern that brought that whole thing up, is the fact that what if you've got somebody that, you know, is like that?
Let me make one more quick suggestion.
And it's just, I mean, it's not like you'd ask that to everybody, but it would be one of those situations that if they're talking about it, obviously you should think about it.
Let's say you have a guy GUL to 90. Just real quick, last thought. And he's age 85, right? And he's like, whoa, I'm looking good. I don't know if I'm gonna die by 90, right?
Right.
This guy is not limited. Let's say his premiums are $500 a month, which is what, $6,000 a year, right?
Mhm.
Let's say he's not, if he wants to send a check in for $2,000 that year, that's gonna increase this. He's not limited to just putting in the 6,000. He can write a check for the difference.
Okay.
It's not gonna max. It's not gonna. It's well. It'll be well within the.
And that was
Yeah.
another question that was coming to
yeah.
mind.
He will have that option if he wants to,
Okay.
and he can actually increase this. Okay.
Right.
That's based on obviously on the cap. Now that's not the guarantee. Obviously that's all.
Right.
But he could do that. Yeah. But other than that, I mean that's a UL in a nutshell. That's supposed to work. I know for every individual we'll go differently on it. But I guess the last thing is if there's no questions on that, then what we'll do is we'll go over any current application or updates that you may have on your stuff. I don't have to. I'll reemphasize this every day. You know, some referral things extremely important. And remember that meeting, please. You know, everybody be here on time at 9 a.m. I'll give everybody contracting. I'll give you your Saturday set. Are you be here Saturday? Yeah, we're here for your release. And then I'll give you yours today if I can right now for you.
Hey, Manny, could you send us a friendly text on Monday?
Yes, I know.
I just put in a warning.
I will.
So, oops. So if you,
There you go, receipts.
yeah, that's what you'd be looking at, right?
Yeah, and that's
Okay.
that's called simple software, so it only does it for 121.
Right.
But go to that Mutual Omaha app.
Okay.
Okay. Now, run a GUL. You see right now what I'm talking about, not the Express, but just a regular one. If you guys want to get started on calling, whatever, you're
Oh, okay.
welcome to do all that.
So guaranteed universal life,
Not the
not
Express.
the Express,
Just
the
that
bottom
one.
one.
And then go down.
Okay.
You can fill all that later.
So-
Go down right there. It says guaranteed period. You see how it says
Okay,
90?
so there's the minimum 90, and then
195,
it's got
105,
5-year increments up from, then it jumps from 105 to
Yes.
120.
Remember I was doing that?
Okay, right. Cool.
That's a little more complex stuff.
Yeah.
Awesome. So that was beneficial then. And that was your appointment, Drew.
Which one? That's the one?
Saturday, for Friday, yes.
Friday? Okay, what time?